Hey guys, in this video, I'm going to talk about the 7 best Vanguard ETFs that have beaten the S&P 500 by as much as 379% since 2004. I spent a considerable amount of time researching every single Vanguard ETF and their investment strategies and their holdings. And of the 56 Vanguard ETFs that are in the equities category, these 7 came out as being the top performing going back nearly 2 decades and through 2 major recessions. In summary, there's 4 things that you'll learn from this video. First point is on an annualized return basis, going back to 2004, these ETFs have beaten the S&P 500 by between 0.4% to 3.9%. And one of the ETFs only goes as far back as 2007, but it still beat the S&P 500 by 125% over the same time period. The second point is that one of these ETFs performed the best during both the Great Recession and the COVID crisis, with lower losses than the S&P 500 and the other 6 ETFs. The third thing is that one of the ETFs beat the S&P 500 by 260% and currently has a higher dividend yield than the S&P 500 ETFs like VOO or SPY. And the fourth point is that the best performing ETF grew a $10,000 investment to $75,000, beating the S&P 500 by 379% over the course of 17 years, and this includes all dividends. And so if you want to find out what that is, be sure to stick around till the very end. Now, none of these Vanguard ETFs have an expense ratio that's greater than 0.1%. So you can rest assured that Vanguard's reputation for rock bottom cost still applies to these funds. And if you're new to investing, you should always know this ratio no matter what ETF you're investing, because the longer your time horizon, the more costly the expense ratio will get. And let me just give you a really quick example. So this chart is from my money blog, and it shows you the growth of a $100,000 investment over 30 years at a 6% annual return. An annual expense ratio difference of just 0.25% over the course of this time period means you'll lose out on $41,450. So keep the expense ratio as low as possible because it will impact your total returns, and it's one of the few things in your control to boost your returns. Every one of the Vanguard ETFs that I'm going to be talking about can be found and purchased commission-free and management fee-free on M1 Finance. If you're not familiar with what M1 Finance is, it's a fintech company that offers, in my opinion, one of the best long-term investing platforms for ETFs. And I mention this because right now, for a limited time, they're offering $30 free for new users who sign up and deposit $1,000 by January 2021. And they're also offering a free 1-year trial of M1 Plus for new users who sign up within 90 days. M1 Plus is their premium membership program, and it offers additional perks not available to basic users. And it typically costs $125 per year, but it's available for free for new users right now. So if you're interested in getting in on these deals and trying out the platform, I have a link down in the description where you can sign up. I am personally using their platform for my dividend portfolio, and it's been a great experience so far. And they make it easy to automate everything. Their user interface is very seamless, and I can rest assured my money is safe and insured. So definitely check it out if you're looking to start investing, and you can just get a nice bonus while you're at it. And don't forget that this is for a limited time through January 2021. All right, the first ETF is ticker symbol MGK, and this is the Vanguard Mega Cap Growth ETF with assets under management of $9.8 billion. This is going to be the second smallest fund of the 7 that I will be talking about. Now, in comparison, VOO, which is Vanguard's really popular S&P 500 ETF, that one has assets under management of $620 billion. So it gives you a little bit of a size comparison here that MGK is basically 1/60th the size of one of the most popular funds that Vanguard has. The expense ratio is 0.7%, and this fund was started in December 2007. It comes right now with a yield of 0.65%, and it holds 100 companies. This ETF is linked to the MSCI US Large-Cap Growth Index, which offers exposure to large-cap companies within the growth sector of the US stock market. The index itself consists of just under 200 holdings, and its exposure is tilted mostly towards technology and then consumer discretionaries, industrials, and healthcare. Between these four sectors, they represent about 90% of this ETF's holdings. And the top 10 largest holdings make up 56% of net assets. So it's not surprisingly that it's going to include big tech companies like Apple, Microsoft, Amazon, Alphabet, etc. So in terms of performance, this ETF had an annualized total return, or CAGR, which stands for compound annual growth rate, but I'm just going to refer to it as the annualized total return for the rest of this video. So for this ETF, it came out at 11.9%, beating the S&P 500 by 2.4% annually over the same time period. The total returns since 2007 has been 382% compared to the S&P 500 at 256.3%, again over that same time period. From a recession performance standpoint, during the Great Recession, the S&P 500 peaked around October 1st of 2007 and then subsequently dropped 52.9% and hit the lowest point around March 1st of 2009. Over that time period, MGK dropped 46.5%, which was 6.4% less than the S&P 500. Then for the COVID recession this past year, the S&P price peaked around February 20th, 2020 and bottomed out around March 23rd, 2020. The S&P dropped 33.4%, while MGK dropped 30.7%. So that was a difference of 2.7%. Now, there's no guarantee that this ETF or any of the other Vanguard ETFs are going to continue outperforming the index. Many of them have very large positions in the technology sector, which is the key driver for their excessive returns above and beyond the S&P 500, certainly within the last decade. But with antitrust lawsuits filed by a number of different plaintiffs, there's free speech and privacy controversies, there are tax and regulation changes that are being proposed, there's high valuation concerns, and a number of other issues. These big tech companies are definitely facing headwinds right now that risk slowing their growth down moving into the future. And so with that in mind, let's go ahead and move on to the next ticker symbol, which is VV. This is the Vanguard Large-Cap ETF, and the index fund version of this ETF is VLCAX. For each fund moving forward, I will reference the index fund version in case you want to know if you are doubling down on basically the same fund in perhaps a different account. So for instance, I have VFIAX in my retirement account, but then I also have VOO in a taxable account. So if you're unclear what the difference between an ETF and an index fund is, be sure to check out this video right here. Now, this fund has assets under management of $31.6 billion. The expense ratio is 0.04%, which is tied for the lowest ratio of any of the ETFs on this list. The inception date is January 2004. The yield is 1.46%. And it's holding 556 different companies. This ETF is tracking the performance of the CRSP US Large Cap Index, which is a broadly diversified index of large US companies. And they represent approximately the top 85% of the US market capitalization. Again, the technology sector is heavily represented in this ETF, along with consumer discretionary, industrials, and healthcare. The top 4 companies are in fact the same as MGK, but the top 10 largest holdings only make up 26.6%. And it makes sense since this ETF holds more than 5 times the number of companies compared to MGK. The annualized total return is 10%, which is beating the S&P 500 by 0.4% annually over the same time period. And the total returns is 403.7%, while the S&P 500 was 371.4%. In terms of recession performance, during the Great Financial Crisis, VV dropped 52.5%, while the S&P 500 dropped 52.9%. So very similar. But then for the COVID crisis, VV dropped 34%, while the S&P 500 dropped 33.4%. If you're considering using any of these funds to build a complete stock portfolio, I would think that VV is a very strong candidate to be a core ETF because of its large holding size. It has very good sector diversification, and it has a really low expense ratio, which is very comparable to VOO and VTI. But if you're not familiar with the core satellite strategy for building a robust stock portfolio, be sure to check out this video right here where I go into a lot more detail. The next ETF ticker symbol is VHT. This is the Vanguard Healthcare ETF, and the index fund version of this is VHCIX. The assets under management for this fund is $14.1 billion. The expense ratio stands at 0.10%, and it was started in January 2004. Currently, its yield is 1.21%, and it holds 458 different companies. The fund is designed to track the performance of the MSCI US Investable Market Index, the Healthcare 2550. So this is an index that's made up of stocks of large, mid-sized, and small US companies within the healthcare sector. And then within the healthcare sector, the biggest representation is in the pharmaceuticals, the healthcare equipment subsectors, and those make up close to half of the ETF's composition. And then the top 10 large companies make up about 41.5%, and this includes Johnson & Johnson, United Health Group, Pfizer, and Merck. The annualized total return is 11%, which means this beats the S&P 500 by 1.4% annually over the same time period. And then the total return since 2004 is 487.5%, while the S&P 500 over that same time period was 371.4%. In terms of recession performance, during the Great Recession, this fund dropped 37.2%, while the S&P 500 dropped 52.9%. Then for the COVID recession or the COVID crisis, this fund dropped 28.4%, while the S&P 500 dropped 33.4%. So on those two metrics, this is the best ETF with the lowest losses during both recessions out of all the ETFs in our list. The next ETF is the ticker symbol VUG. This is the Vanguard Growth ETF, and the index fund version of this ETF is VIGAX. It has assets under management of $138.7 billion, which means this is the largest ETF in my list. The expense ratio is 0.04%, and it ties with VV for the lowest rate of any of the ETFs on the list as well. It was started in January 2004, and it currently has a yield of 0.66%. It holds 257 companies, and basically this fund is tracking the investment returns of the CRSP US Large-Cap Growth Index, which is an index that's predominantly made up of growth stocks of large US companies. So it has a very large exposure to the technology sector at about 45.3%, and the top 10 companies in this ETF make up 46.4%. The annual return is 11.5%, which means this fund beats the S&P 500 by 1.9% over the same time period. And again, the total return for this ETF is 524.6%, while again the S&P 500 was 371.4%. And in terms of the recession performance of this ETF, during the Great Recession, this one dropped 48.3%, while the S&P 500 dropped 52.9%. And then for the COVID recession, this ETF dropped 31.4%, while the S&P 500 dropped 33.4%. The next ETF on our list is the ticker symbol VBK, and this is the Vanguard Small Cap Growth ETF. The index fund version of this ETF is VSGAX. It has assets under management of $31.7 billion. The expense ratio is 0.07%, and this ETF was started in January 2004 as well. Its current yield is 0.44%, and this happens to be the lowest yield of the 7 ETFs that we're looking through. It's holding 592 companies, and this is actually the largest number of holdings of any ETF on our list. The ETF is actually tracking the performance of the CRSP US Small Cap Growth Index, which measures the investment returns of small cap growth stocks. So it has about equal exposure to technology and healthcare at 24% and 23.4% respectively. And then with the industrial and consumer discretionary sectors added in, these 4 sectors basically represent 79% of the portfolio composition. And then the top 10 companies make up 8.2%, which is the lowest concentration of all the ETFs. The annualized total return is 11.6%, And that means that this fund beats the S&P 500 by 2% over the same time period. In terms of total returns, we're seeing 539.8%, while the S&P 500, again, had 371.4%. And in terms of recession performance, during the Great Recession, this fund dropped 55.3%, while the S&P 500 dropped 52.9%. Then for the COVID recession, it dropped 38.4%, while the S&P 500 dropped 33.4%. This means that of the 7 ETFs on our list, this ETF experienced the steepest drop during the COVID recession. The next ETF on our list is a ticker symbol VCR. This is the Vanguard Consumer Discretionary ETF. And the index fund version of this ETF is VCDAX. The assets under management for this one is $4.8 billion, and this happens to be the smallest ETF by assets on our list. The expense ratio is 0.1%, and it was also started in January of 2004. The yield on this ETF is currently 1.71%, and it's actually the highest of any ETF on the list. This actually beats the current yield of the 3 most popular and largest S&P 500 ETFs, with SPY at 1.5% and IVV at 1.55% and VOO at 1.52%. This ETF is holding 299 different companies, and it's basically tracking the performance of what is called the MSCI US Investable Market Index, the Consumer Discretionary 2550. And this is an index made up of stocks of large, mid-size, and small companies within the consumer discretionary sector. And so this means it has the biggest exposure in internet and direct marketing retail, followed by auto manufacturers, and then restaurants being the top 3 categories. The top 10 companies make up about 55.1%, with Amazon, Tesla, Home Depot, and Nike being the top 4 largest companies in this ETF. The annualized total return is 12.5%, means this beats the S&P 500 by 2.9% over the same time period. And the total returns ever since inception is 631.9%, while the S&P 500 was 371.4% during the same time period. In terms of this fund's recession performance, during the Great Recession, this fund dropped 56.3%, while the S&P 500 dropped 52.9%, making this the steepest drop of any of the ETFs on our list during the Great Recession. For the COVID recession, this ETF dropped 36.3%, while the S&P 500 dropped 33.4%. And that makes this one the second steepest drop during COVID, with the first being VBK. Now, the best performing ETF is a ticker symbol VGT. This is the Vanguard Information Technology ETF. And the index fund version of this ETF is VITAX. It has assets under management of $44.4 billion, which makes this the second largest fund on our list after VUG. It has an expense ratio of 0.1% with an inception date of January 2004. The current yield is 0.82%, and this ETF holds 299 different companies. And it's tracking the performance of the MSCI US Investable Market Index Information Technology 2550. And this is an index made up of stocks of large, mid-size, and small US companies within the information technology sector. So technology sectors make up more than 87% of the portfolio's holdings. And the top subsectors are tech, hardware, storage, and peripheral, which makes up 21.9% of the technology subsector, and then followed by system software at 19.4%, and then semiconductor companies at 15.8%. The top 10 largest holdings of this ETF make up 56.9% of the total assets, with Apple, Microsoft, Visa, and Nvidia rounding out the top 4 companies. The annualized total return for this ETF is 13.5%, which is 3.9% higher than the S&P 500. The total returns ever since inception is 750%, while the S&P 500 was 371.4%. And during the last 2 previous recessions, during the Great Recession, this ETF dropped 49.7%, while the S&P 500 dropped 52.9%. Then for the COVID recession, this ETF dropped 31.2%, while the S&P 500 dropped 33.4%. So not only did VGT outperform the S&P 500, but also it showed less downside risk based on its performance during the last 2 recessions. So if you enjoyed this video or found it valuable, be sure to hit that like button down below and be sure to subscribe and hit that notification bell so you don't miss out on any future videos. Thanks for watching, guys, and I'll see you guys next time.